Recently, I finished a book by Doris Kearns Goodwin called The Team of Rivals. It was about Abraham Lincoln during the Civil War. And Abraham Lincoln's Secretary of State was a gentleman named Salmon P. Chase. Salmon P. Chase was the first person to issue a greenback note. The Civil War was raging. The South had already issued their currency, and it was deflating, hyperinflating. Secretary Chase was under immense pressure to print money, but he was highly skeptical. He feared that giving the government the power to print money could lead to irresponsible fiscal practices in the future. His entire life, he was dedicated to the anti-slavery movement, and because of that, he decided to take the leap. He knew the North needed to win the war. They issued the greenback dollar. Secretary Chase had his face on the dollar because he had future aspirations to run for president, and he knew this was going to be circulating all over the world. And you might be wondering, why is Lee telling us about the Secretary of Treasury from the Civil War? Well, Secretary Chase's great-great-grandson is actually in the room today. He's going to be bringing us our final remarks. He is an economist. He's the chief economic advisor at GreatX. He's also a tenured professor of economics and chair of the management department at his university. In addition to his role in academia, he's been a real estate investor for over a decade. He specializes in law, economics, economic development with a focus on property rights and economic growth. Property rights is a theme that has come up several times today. So without further ado, allow me to join me in welcoming the great-great-grandson of Secretary Salmon P. Chase, Alexander Chase Cartwright.
Hey, good afternoon, everybody. It's a pleasure to be with you, and I appreciate the opportunity to meet with everyone today. Thanks for that very kind introduction, Lee. I appreciate it. Let me start off by saying that wealth is everybody's business. Today we're going to talk about financial wealth, but wealth can come in a lot of different forms. Wealth can come in knowledge, it can come in good health, it can come in having free time and autonomy. I'm very grateful that after giving birth to our first child less than 2 weeks ago, my wife is able to join us today. That's wealth. But today we're going to focus on financial wealth. And if you look at the history of wealth, what you'll quickly come to realize is that the only constant is evolution. If we look at the prehistoric era, that is pre-3000 BC, wealth is found in having access to tools. Tools are wealth, animals are wealth, access to fertile areas are wealth. And just a little bit beyond that, 3000 BC to 1000 BC, in what we might call the early agrarian era, wealth is food supply and the ability to store food. That was what defined wealth. After that, in the Bronze Age and early civilizations, things like spices, jewelry, and textiles are wealth. And in the classical era, 500 BC to 500 AD, wealth is defined by how large an empire is and how many slaves that empire has to employ. In the early medieval era, from 500 to 1200 AD, wealth is defined by how much land someone has, the feudal system, and how many serfs someone had to work that land. Monarchies came to define wealth. And in the high medieval era, from 1200 to 1500 AD, wealth is defined by access to trade routes and precious metals. In the age of exploration, 1500 to 1700, wealth is defined by colonization and access to global commodities. Things like gold, sugar, tobacco became the definition of wealth. And in the industrial era, wealth is defined by machinery that made mass production possible. And then in the modern capitalist era, which a lot of us are familiar with, 1900 to 2000, wealth is defined by consumer goods, making consumer goods massively available, widely available, and in energy and access to new kinds of energy. From 2000 onward, this is called the digital and knowledge era. Wealth is now defined by information, big data, intangible things. And economic productivity is the ability to take those intangible things and harness them for economically productive purposes. The point here is that as our world is changing, Quite literally, as geography is changing, as national borders are changing, as habits are changing, and as the economy is becoming more productive, what we think of as wealth is also changing. And 10 years from today, what we think of as wealth will be different. In order to think that that won't happen would be economically ignorant. If we look at the history of wealth, I think that you see a pattern begin to emerge. Originally, wealth is very decentralized. It's very personal. It's something that individuals controlled. And wealth was things that brought individuals things like security, safety, and it allowed them to be independent. But as the economy grew, wealth became more centralized, defined and controlled increasingly by things like governments, large financial institutions, and monarchies. And I think right now we're seeing a shift. Wealth is becoming decentralized once again. Things like digital assets are making it easier for people to control their own wealth, define their own wealth and their own contracts. The power is now moving back to the individual as wealth becomes decentralized. Now, in order to understand and unpack that, I've got to ground you in what I would consider some very good economics. And to understand the history of wealth and economic growth, you got to understand one of my favorite economists, Hernando de Soto. He wrote a great book called The Mystery of Capital, which is about property rights. And he's an advisor to 30-plus heads of state on property rights. Hernando de Soto is contributing to, in economics, what we call this mystery of wealth literature. That is the age-old economics question of why are some nations rich and other nations poor. And there have been a lot of propositions about why this is the case that have been put up by economists over time. One that you hear all the time is one nation's rich and one's poor because of its geography. Another common proposition is that economic growth is dependent on a nation's natural resources, things like copper or oil. And then sometimes you hear that economic growth is dependent on a country's culture. Under close scrutiny, none of those stories hold water. What really defines whether or not a country is going to grow and become wealthy is the stability of its property rights system. At a very fundamental level, you got to have property rights in order to own something and to trade it. And once you can own something and trade it, you can price it. And once you can price it, entrepreneurs can more efficiently allocate it, and they can design more complex pricing schemes, as our friends from financial institutions can tell you all about. But fundamentally, geography, natural resources, etc., none of that means anything if you can't own it and you can't turn around and price it. Now, one of the big questions in economics is, how do you get that property rights technology that we've got in places like the United States and the developed world and get it to the undeveloped world or the developing world? And no economist has got an answer to that. We know that we cannot copy and paste the US Constitution in Peru for a couple reasons. I mean, quite practically, a lot of nations don't want it. And even those that do, you don't get buy-in from all those different citizens. So property rights exist around the world, but not all in the same form. And De Soto did a landmark study on property rights in the developing world that I want to share with you to explain this concept. So let's say you've got a truck, a simple traditional pickup truck in the United States. And let's say the same truck exists in the Middle East. Let's say the same truck exists in South Africa, Latin America, and in Southeast Asia and China. The same truck, the same physical capital, got the same gas mileage, towing capacity, everything about the truck is physically the same. That truck is significantly more valuable. It is significantly more economically productive in the United States. Not because the laws of physics are any different here, but because we've got a different property rights system. We've got the most advanced property rights system in the history of human existence. And what you can do with a truck in the United States at a basic level is you can take the title of it, this is very important, down to a local bank. And the bank will accept that title as collateral. And with that piece of collateral, you can get a loan against the truck and maybe buy a lawnmower, something that someone could use to start or expand their business. The key point is, with the title, you can keep the truck and get the lawnmower. In other words, when I give the title to the bank, I lend the bank my exchange rights. I can't sell the truck, but I keep my use rights. I can still use the truck. The title system allows that divorcing of property rights into a new complex property right to be possible. And the bank is only willing to trust in the title because we've got a court system, an arbitration system that the bank has confidence in, or that any lender has confidence in. Now in Peru, they're not socialists anymore. You can own things, you can own a truck, but their ownership is quite simply possession. You own something just because you've got control over it, physical control. A lot of people in Peru, most people, don't have titles to their homes, much less their truck. So what does that mean? You want to collateralize your truck in Peru, you've got to hand the bank the keys. This makes that physical technology significantly less economically productive because it can't be leveraged. Financial guys are like, wow, I can't imagine a place where we can't leverage stuff. It's terrible. And this is why they're poor. Now, what if it was possible to take the most advanced property rights system that has existed in the history of human existence and somehow make it accessible to folks all around the world? Economists have been trying to figure that out. It's exactly what digital assets are doing. And I want to walk you through how digital assets are able to do that with something traditional like real estate. In order to understand that, let's just unpack real estate ownership and investment for a moment. You can have real estate not as an investment, just to use it. We might call this buying real estate for a very practical utility value that you get from real estate. Of course, you could also buy real estate to own it and derive some income from it. You might get some rental yield, some business income, the tax benefits that come with owning real estate. But as a real estate owner, you also absorb legal and fiduciary responsibilities to your tenants, to your lender, etc. Comes with business risk. And so there's demand to own only the economic benefits of real estate. And we've created property rights, financial products that allow investors to do just that. Get the appreciation, get the rental income, get the yield, the tax advantages from owning real estate, buy real estate, enter the real estate market with small amounts of capital, and therefore diversify into a diverse geography of real estate holdings to create a portfolio. That's possible, and it exists in things like REITs, real estate mutual funds, private real estate investment products, etc. But here's what doesn't exist. That you can't do around the world. That cannot be done globally. Global investors don't have access to that. And not only do global investors not have access to that, but even here, it's difficult to invest in real estate, I would say not really possible, in a way that comes with capital protection, a minimum assured yield, and in a way that's highly liquid. Those things don't exist. So property rights aren't accessible globally, but not only that, those property rights could become more advanced technologically. Those benefits, those four benefits that I just described, they are possible. And digital assets can enhance a traditional asset like real estate and make those four things possible. Bring them to a new audience and make real estate a fundamentally more economically productive thing to own. What if I were to tell you that it's possible to invest in real estate with capital protection? It would be possible to invest in real estate with a minimum assured yield, not a preferred return, but a minimum assured yield. That doesn't exist in the market today. What if that could be done and have uncapped upside potential with your limited downside? Be able to choose the real estate asset that aligns with your investment goals, not invest into a fund where the fund manager selects the real estate asset. And what if you could confidently predict the potential upside of the property using real-time data? And what if that could be done from anywhere in the world, enabling people around the world to get a dollar-backed income? In other words, a global income. And what if that could be done without having to absorb the legal and fiduciary responsibilities that come with owning a piece of real estate? What if you could just get those economic benefits? Like I mentioned, those don't exist right now. But in a digital asset world, they can. Now, why would we want that in the first place? Well, because those 7 characteristics can give investors holistic risk protection in a way that's not accessible right now. And why is holistic risk protection important when investing in real estate? I would argue it's particularly important when investing in real estate because most people invest in real estate in order to create generational wealth. That is, wealth that will last a lifetime and can be passed on for another person's lifetime. If you want to have an investment perform that long, you need to be insulated from risk. And with the 7 dimensions above, capital protection insulates you from capital risk. A minimum assured yield insulates you from growth risk. Having uncapped upside insulates you from income risk. Being able to choose a real estate asset of your choice and not rely on a fund manager insulates you from volatility risk. Being able to confidently predict potential upside before investing insulates you from opportunity loss risk. Being able to do this globally and get a dollar-backed income insulates investors from inflation risk. And of course, being able to do it all without any fiduciary or legal liability that comes with owning real estate insulates you from security risk or control risk. These turn real estate, digital assets, allow us to create holistic risk protection, which fundamentally changes real estate, enhances it into an all-weather generational asset like never before. So how will that change individual wealth creation? On a very practical level, what we're doing is making the property rights technology that exists in the United States better and accessible to a global audience. Now all of a sudden, the investor in Brazil, South Africa, Australia, India can take advantage of the wonderful technology, the property rights technology, the governance technology, and the financial innovation that exists within that. Our advanced financial markets, the benefits of those are now accessible globally through digital assets. So someone from anywhere in the world could own a hotel room in New York. They could own a hotel room in Dubai. They could choose by city, by brand type, look at past performance, and predict future performance before choosing to make an investment in a certain piece of real estate. It doesn't have to be limited to the hospitality space. Somebody could own and invest in student housing in London, a multifamily unit in Mumbai, or a type of industrial real estate in Australia. They could own, earn from, and trade digital assets that share profits in these pieces of real estate from anywhere in the world. So back to the cycle of wealth for a second. Wealth started off as something that was very much individual, and it was decentralized. It was something that people needed to touch. It was something that required a lot of trust between individuals to facilitate exchange. And as the economy became more globalized and transactions more complex, we came to rely on large institutions, banks, governments, and these helped create efficiency. They unlocked wealth for sure. But the trade-off was the individual lost control over the terms of their wealth. And that is now changing. We're now entering decentralization 2.0, where things like blockchain, tokenization, Web3 are enabling trustless systems to be built for investors to access globally more advanced financial products than ever before. We like to call that the new age wealth, this transition. I'd like to welcome everybody to the new age wealth. If you'd like to learn more about how we're transforming and disrupting real estate investment, please see GreatX.com. Thank you very much.